Yeah, prepayment is another asset that you are expected to know how to test in your syllabus. Yeah, so prepayment. What is prepayment? Yeah, anybody who wants to try prepayment?
It's a payment that is done in advance.
Fantastic. You've made payment in advance, but you have not enjoyed the service or you've not received the goods. So, because if you don't understand that as well, you cannot test. So, prepayment is a payment without service or goods. So, which means you're expecting all of this to come in the future. How do you account for prepayment naturally? You account for payment starting from the opening balance plus payment, which is additional prepayment you are making. Then the part that you have enjoyed, you amortize it, and you have your closing prepayment figure. That is the way your prepayment works. And a typical example is your rent. Yeah. Most of the commercial buildings, they pay rent once in a year or quarterly. So which means if every January we are meant to pay rent, or every depending on when the lease starts. Sometimes the lease will not start exact January. It might start maybe in July 1st. So let's say you are paying rent July 1st and your rent is for 1 year. If your year end is December 2024, it means that you have paid a rent for July 1, 2024 to 30th of June 2025. You have paid, let's say, $12 million for your building. By December 31st, you have only enjoyed 6 months of your rent. So, which means you will have amortized 6 million. This will have been amortization because half of your rent has gone. In that case, 6 million has gone. Then you have 12 minus 6, which is still equals to 6 million left as prepayment. And that is what you have as at 31st of December. So you're going to have 31st of December payment. And you will see if you want to do opening movement schedule, yeah, for this kind of transactions, your opening, you started with you paid 12 million, you amortize no addition, zero, then you amortize 6 million, and you are left with 6 million prepayment. So which means you need to audit all of this. And in that case, what you have to do, this one is pretty very straightforward. Like I said, opening is all about tracing to the audited financial statement. If there are payments, let's say instead they open with zero and the old 12 was made during the year, then in that case, you have addition of 12 here. Yeah. And how do you open 12? Or audit this 12, sorry. It's, it's a payment, right? And I've told you the only way to audit payment is to trace to bank statement. So you're going to trace that to bank statement. So trace 12 million to bank statement. Right. And the amortization of 6 million, you need to recalculate it. Like I told you, anytime you see amortization is similar to depreciation. It's about recalculation. Once you do this, you do this, you do this, you already have this figure, right? And to test this figure itself, you do analytics because prepayment is very predictable. Yeah, very predictable. You expect the last year prepayment to be the same as this year prepayment. Because think about it, by 2026, it will be the same figure because by July 1st, 2025, they will pay another 12 million and you amortize 6 months. And by end of the year, they will still have 6 million left. You can make a reasonable assumption and say you want to use year on year analytics. So, which means prior year is your expectation. Yeah. And if your expectation is not the same as the actual, then you discuss with the management to explain why. And they can tell you maybe their landlord has increased their rent or their landlord has given them some discount on rent. or they've reduced the space they are using, or they've increased the space they are using. So, but it's a reasonable assumption to make as an auditor to say, I'm doing analytics and I'm forming my independent expectation using the prior figure as my expectation. Yeah. So that's prepayment. That's pretty straightforward. Um, the most, maybe not most important, but extremely important balance, which is the last one I'm going to touch on, is inventory for assets. Yeah, is inventory extremely important. Inventory, account receivable, PPE, those are the big chunks. You cannot joke with them. Yeah, inventory. Yeah. And I believe you know what inventory is, but the starting point is, please always remember, like I said, what is the standard saying about it? And this IS2. And this standard says that you need to measure inventory at lower of cost. So it's the lower of cost, yeah, versus net realizable value. So whichever is lower, that should be the measurement of your inventory. So that when you want to do your audit or you want to develop procedures, you bear this in mind. You cannot carry your inventory at an amount that is higher than the cost, because you cannot have a figure as inventory more than the cost. That is the requirement of the standard. Or maybe the net realizable value is even less than the cost, and you're still carrying that inventory at a cost. That is wrong. So, which means you must always know this. You must always know this. And the lower of A or B is the value of your inventory. Very important to know that. And you know that inventory are those materials or finished goods that an entity will use in its ordinary course of business. Yeah. So, very important. And what are the assertions? Like we always do. It's a statement of financial position item. So it's the same assertions that we use for account receivable, which means we're talking of existence. So how do we know that this inventory truly exists? We need to check. Does it exist? That is when inventory counts will come from. Similar to when we're doing account confirmation for account receivable. Yeah, existence, valuation, very important. And you see, inventory count as well will play a big role in this one. Yeah, rights. Are we the owner of the inventory? I mean, is it our clients? Are they the owner of the inventory? We need to check. P&D, have they presented it, all the disclosures properly on the financial statement? Do we have complete inventory on record? Completeness, we need to check. So these assertions are the same assertions we looked at for account receivable. And we're still going to be looking at it here for the inventory because it's that critical. Right. So now that we know the assertions, what is the risk? Because it's an asset, I told you any asset, risk is always an overstatement. So the risk is that inventory is overstated. And how can it be overstated? Yeah, either does not exist, so fake inventory, or not client's own. They are carrying inventory that are not their own, e.g., maybe a consignment. You like this kind of question. Consignment inventory. Consignment inventory are those inventory that are being kept in your warehouse, but they are not your own. Probably they are just keeping it in your warehouse and they're saying, help us sell it if you find a buyer. Doesn't mean it's yours, because whether you sell it or not is not your problem. Yeah, you don't have risk and reward, so it's not yours. Yeah, or maybe they are even damaged inventory and they have not done impairment on them and they're still carrying them at cost and they're already damaged. So in that case, the value of that inventory should be lower. But the clients will not want to show all of this because they want to overstate their inventory. They want to look good. Yeah. And you don't ever trust your clients. You must always do your audit procedures to check all those assertions. Right? So where do we start from? Let's start from existence. How do we confirm that inventory exists? You all know it. The most important way is through inventory count. So the same way confirmation is very critical for account receivable, the same way inventory count is very critical for inventory, because inventory count addresses a lot of assertions. It addresses existence, it addresses valuation. Very important, right? So how is inventory count done? Let me explain this to you, please. And I'll start with a warning. Please, in inventory count, auditors are not the one counting, because I see even auditors make that mistake. You go for inventory count, you are not there to go and count. Auditors are meant to be there to observe the client counting. So your procedure is not that auditors should perform inventory count. That is a wrong procedure. Yeah. Perform inventory count is not your procedure. Is to observe, is for the auditors to be present and observe inventory count exercise. Yeah. Or you are obtaining inventory count reports. But what is inventory count? Inventory count is an activity whereby your clients will sit down and start counting all their inventory. And when they are done counting, they agree whatever they have counted with the general ledger to be sure that the report and the ledger reconcile. And if there's any difference, the inventory count report take precedence, because that is the true existence that we know. The general ledger cannot supersede the inventory count. Inventory count supersedes the general ledger. Okay. And clients can do this monthly, they can do it quarterly, they can do it annually. However, auditors are required to observe at least end of the year inventory count. So you see where I'm coming from. Some clients even do it continuously, which means every time they buy, they update, they count, they update, they count. Can auditors be doing all of that? No. However, auditors are required to observe at least the one that is done at the end of the year. Yeah. And you, as an auditor, you need to understand your responsibility, because you are not there to count. Yeah. So let's look at auditors' responsibilities. Let me break it down like this in three categories: before the count, during the count, and after the count. What are the auditor's responsibilities? Very simple. I want to simplify it like that. Before the count is all about logistics. Yeah. And when you're talking of logistics, we want to know what time are we going to come and observe the client during the counting, on what date we need to know. Yeah. Where is it going to take place so that we can come, venue. Auditor needs to know all of that. So you need to plan logistics. Auditor needs to review the procedure, the count procedure, because auditor will be observing the client doing the counting based on this procedure. So if you have not reviewed that procedures before you go, which is during, how will you know that they are doing the right thing? Then that means you are just watching movie, right? And you're not there to watch Netflix. You are there to really watch them do what they should be doing according to their procedure. So before the count, you must have looked at the procedure. Okay. And likewise, auditors need to put together their team. So who are the people that will be going to observe? How many warehouses are we going? Who should go to where? So they need to form the audit team that will do it. Yeah. And if you have more time, you should review prior paper to see whether there are popular problems. Sometimes you can see if there are problems that are likely to happen during the count. So these are the things auditors must do before the count. And during the count, what must they do? Very easy. As I said, all they need to do is to observe. They need to observe the counting. So observe number one, and the counting is done in accordance to the instruction. So counting is following instruction, yeah, which is the procedure that you're looking at here. Yeah. You want to observe that inventory are sequentially numbered, because if they don't have tags, it will be difficult. Yeah. You are also observing that damaged goods are separated. You need to look out for damaged goods because you don't want your client to be reporting damaged goods as if they are good. In that case, that's an overstatement. Likewise, consignment goods, which means those goods that are not your client goods, are not being counted. So they have to be excluded. And it only makes sense. How can you be counting the goods that are not your own and be adding it to yours? And likewise, observe that there is no movement of goods, of stocks. Yeah, no movement of stocks. Because when I'm doing my accounting, I don't want clients to be moving some goods from one shelf to another, because that's how a place that I've counted before, they will now move things from there and move it to another place that I've not counted. And I will now be counting one good 2 times, 3 times, and overstating their inventory. So no inventory must be um, moving when we are doing inventory count. It is prohibited. Because once you do that, then you are giving room for double counting. So you have to also be watching that as an auditor during the counts to be sure that nothing is moving. That is doing. Finally, after the count, the work has been done. You've prepared during the before, you have done it during the accounting. Then after, what do you have to do? The first thing you have to do, you have to sign off on the sheet, the count sheet. That's what I mean on the sheet. You have to sign off on the count sheet because you were there. And likewise, you have to, what can you do? Yeah, you need to ensure. So you need to check that the count sheet and inventory register agree actually. So you need to check because that's the essence that inventory GL agrees to the count sheet. But if not, then there's a discrepancy which must be reconciled. And like I said, the count sheet will take precedence over any other form of information because the count sheet that shows the reality, yeah, of what we should have. Okay, so that's what you must do before, during, and after the count. It's very important. And I think I've even seen an exam question that actually asked you that what should you do as an auditor? What's your responsibility during, before, and after inventory count? So that's the summary that I've made for you here. And this should make your life easy. I can also add one here. You can do a sample count here, sample count, but not that you have to count all the inventory. You can just do a sample count if you want to, which means you can just select a particular shelf and say, okay, step aside, Mr. John, my client. Let me just see what you just counted. And you can just count 1, 2, 3, 4, 5, 6, 7, 8. Let me see what you recorded. Oh, you recorded 8. That's fine. And that's fine. But you don't need to be counting everything with him, but you can just randomly just pick one shelf and do a sample count. Yeah, just to be sure that it's counting accurately. That is it with inventory. And I think if you look at our movement schedule, let's see, have we been able to address what we need? So inventory existence, inventory count will do it. Valuation, inventory count will do it. But likewise, we can still check invoices for those inventory that we purchased, right? And likewise, rights will also be addressed with that. Yeah, completeness. For completeness, is going to be about um, doing your cutoff testing for purchases, which I'm going to also touch on right now. Very important. I'm not going to leave it because you also need to know how that is relevant to inventory. So remember, when we talk about account receivable, we spoke about sales. So when we talk about inventory, we'll be talking about purchases. So which means for purchases, we also need to talk about the cutoff. We talk about cutoff for sales. So we're going to talk about purchases because, like I said, for you to have confidence on completeness, you need to have confidence on your movement schedule. And you know your inventory usually will start from your opening plus purchases, which is what we're talking about. The opposite is sales for account receivable. Less cost of sales, which is disposal. Yeah, and that will give you closing. Usually that's how your inventory is going to move. Yeah, you're going to, you might also have a write-off, disposal and write-off. So if there's a write-off, yeah, you'll see it there. So this disposal is your cost of sales. Yeah, and this your write-off is the damage inventory. But this is what we're talking about now, which is purchases. And I said you must test for cutoff. Yeah. Because when all of this is done, then completeness can be ticked off. And how do you test for cutoff? Similar for sales. You need to ask yourself, at what point do you say inventory has been purchased? Yeah. So what document would signify a point of purchase?
GRN.
Thank you very much. GRN. Thank you. And that is it. GRN is for inventory. Dispatch note is for revenue sales. So GRN is the point where you will say you have purchased because good receipt notes, GRN stands for goods, in case anyone does not know, good receipt note. So once again, it is not invoice, it is good receipt note that you will use. Because good receipt note shows that you have received an item. And when you have received it, whether they have issued you invoice or not, you have an obligation to pay for that item. And that is why when the item is delivered, you will debit your inventory because you have received it and you will credit your accrual. And when they now issue you invoice, you reverse your accrual, which means you debit your accrual and you credit your vendor, which is your account payable. And when you run your payment, you debit your account payable, your vendor, and you credit your bank. That is when you pay. Right? So all of this understanding is very important because they're happening at different stages. This is your GRN. This is your invoice. And this is your payment. So same process, but sub-processes inside of it. And you need to understand the implication of each of the documents and how they impact on the accounting and what you'll be looking for as an auditor. So if you are looking for whether inventory exists, whether they've really purchased an inventory, this is what you are looking for. Because if you are looking for invoice, it's too late because invoice could have come after the year end and you'll be making a wrong decision. So for cutoff of purchases, our focus will be on GRN. And just like we did for dispatch note, it will be to select samples of GRN dated before year end. Ensure, remember, when you select it, why? Because we want to ensure that they have been recorded in the current year. And like I told you, that is just one part. You need to write about the other part. So, which means also you have to select GRN post year end and ensure that they have been excluded from the current year. So it means they are not included. They have been excluded from current year, which we are auditing, remember, current year financial statement. And that is how we've been able to test for cutoff of purchases. And likewise, if you want to check for occurrence, then you can ask for invoices or even still ask for GRN. All of that will suffice. But for cutoff, please, it's always GRN for purchases and it's always dispatch notes for revenue. Please don't use invoices. Invoices will give you occurrence, but not cutoff. Any question? Because this is where I am going to leave it for today.